Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate a consistent return year on year. So the first thing we want to do is open up our brokerage platform. I use Tasty Trade, and we're going to be using options. We're specifically going to be writing our options contracts. So we need to know where we are in the options cycle, right? So typically what we would do is we would come into we just pull up, say, Apple or something like that, and just see where we are in the options chain, in the options cycle. Even as you can see here, we'd probably need to go, October 18th is getting a little bit thin at 28 days. We like to be between 30 and 60 days, so we'd be maybe looking at the November 15th. But because of this weird time where you're neither right or wrong for going 28 days out or 56 days out, I think it's a good opportunity to have a look at some futures. We put on two futures positions yesterday, the Aussie dollar and the Canadian dollar futures. Um, and that's what we're going to have a look at today. For anyone that isn't familiar with futures, you're about to learn what all the hype is with futures. So futures uses span margin as opposed to Reg T margin. So a lot of things are taken into account when calculating your buying power when it comes to futures, the volatility of the product, the size of the product, what else is in your portfolio. Everything is taken into account. And basically, long story short, it means that you can be far more capital efficient with futures. So let's have a look. So again, the same thing. Obviously, there's no earnings with futures, so we don't need to filter out earnings. Everything is typically very liquid. However, we still want to rank everything from high IVR to low IVR, right? Yesterday, we did place a trade on the Australian dollar futures, and I believe IV rank was IV rank yesterday was very high. Actually, it was, I can't remember off the top of my head, but it was much higher than 51. As we can see here, there has been a bit of a contraction today. Um, but yeah, so we want to list everything from high IV rank to low IV rank. And typically speaking, if you have a smaller account, currencies will probably be better for you. Maybe you could look at some stuff with bonds or soybeans or something like that. But generally speaking, currencies usually fit quite well with small accounts. If you have got a large account, by all means, you can just trade anything you want here the same way. It's just the sizes of the contracts are different. So we're going to have a look at putting on a trade on, say, uh, the Canadian dollar with an IV rank of 69.3, the Canadian dollar futures. Let's have a look at the option cycle. As you can see here, for futures, it is slightly different. Um, the cycles do work slightly different, and between different futures contracts themselves, currencies and soybeans will have different expirations, for example. So what we can do here is we can go with the November 8th because that's closest to 45 days. We can go with November 8th, and we do, of course, have a position on already, but we're going to mock up another position. So there is no 16 to 20 delta on the call side. Um, there is a 15 delta on the put side. There isn't on the call side. We are going to be slightly more aggressive on this position. The position that we put on yesterday was slightly more conservative. We are going to be slightly more aggressive with this position, and we're just going to really highlight the effects of span margin and how capital efficient you can be with futures. So keep in mind now, this is a naked position. This is a naked strangle. There's 22 deltas on the call side and 25 deltas on the put side. So we're trying to be as delta neutral as we can. We do still have a high probability of profit of about 64%. We'd probably have, I know it's not displayed here, but we'd probably have somewhere around about a 75 to 80% chance of hitting 50% of max profit at some point over the next 49 days. So as you can see, this is a naked position, very high probability trade, same as everything we've gone over before. But let's look at the difference here. So obviously the price, right? The price of the contract. This probably looks not very appealing, but that's because of the contract multiplier. So on the Canadian dollar futures, I think it's a contract multiplier of 100,000 shares or 125,000, something like that. It's basically futures. It's a much bigger contract than what you'd be used to trading with equities, basically. So what this means, after you've used the multiplier, you'd collect $380 upfront in premium. And this is where the magic is, right? Your broker is only going to require $650 in buying power, right? So your broker is going to require $650 in buying power, right? But you collect basically $400 upfront. As you can see here, the return on capital on this trade is outrageous. Uh, with it being a naked position, for anyone out there who does regularly sell naked positions, you'll be able to appreciate how powerful this is. Even if you have a covered position, let's say, for example, if you were going to sell an iron condor, right? If you were going to sell an iron condor, you'd struggle to get a return on capital that's like this, with a probability of profit that's like this. So you get you get the benefits of having a naked position with a high probability of profit, but you get a super high return on capital because of the way that the buying power is required. Now, of course, you do need to keep in mind that these are large contracts, right? Your margin can expand, right? It's called margin expansion, basically meaning that your buying power requirement can increase. So it's at $650 right now, but if things start to go sideways or very extreme in one direction, um, then by all means this buying power requirement could double very easily. So that's the only trade-off that you need to keep in mind, right? You are far more capital efficient, however your margin can expand. What can we do to manage that? Well, we can just make sure that we are allocating um, the correct amounts to short premium and to futures specifically in our portfolio. If we've got 10 grand in our portfolio, we do not want to be using 90% of our account selling futures, right? That would be insane. You probably most likely will get margin called at some point. So you want to keep everything in check. And the way you can do that is by using our position sizing template. So how does a position sizing template work? Well, you put in the size of your portfolio. So let's say if the size of your portfolio is $5,000, below you will then enter in what the current VIX level is. Let's say if it's at 17, now let's just say if it's at 32.9, right? Everything below will then be automatically calculated for you. At this point, all you need to do is follow uh, what's written here as your guideline. Use it to form the backbone of your portfolio. It tells you how much buying power to allocate to defined risk positions, undefined risk positions, and how much buying power to allocate to short premium in general, compared against your overall portfolio. So follow this template and you'll be fine. It is free. Everybody can get it for free. Link is in the description. Just click on free position sizing template. Just have a little look at our portfolio currently. Hope everything is starting to look green after the FOMC meeting in the last couple of days. We are starting to see volatility come out of the market a little bit. We've been managing GDXJ and UAL accordingly, and it's nice to see that we are seeing some green on the day. It's just GDXJ letting the team down a little bit, but that's fine. That's not a problem. So if you do want to get involved on what positions that we have open, and if you want to trade with us, copy our positions, by all means, click the link in the description, head over to EDS Premium, get yourself signed up. You'll be able to access all of our portfolios, small and large portfolios, so you can copy all of our trades. There is a full course inside, so no prior knowledge is required. We will teach you everything that you need to know. It allows you to learn and earn at the same time. It is a private community, so you can speak with like-minded individuals, and you can also speak with myself directly. There's a 100% money back guarantee. So if you've studied our full course and followed our trades for 6 months and you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part, and it's £1 a month right now. The price will be increasing. However, once you're in, your price is locked in at that rate. You will never need to worry about future price increases. So with that being said, I'll see you guys on the inside.